Once again, thank you for all who have joined us. We are excited to have Eric present tonight as one of our ORCID webinars on the insurance renewals and current market conditions. And so I will turn it over to Eric to take us through his presentation.
Thank you, Robbie. Good evening, everyone, and thank you for joining us tonight. I'm Eric McPhee. I'm Executive Vice President and Director of Risk Management for ORCID New York. Thank you, Robbie and Chelsea, both of you, for the technical production and the hosting tonight. We're happy everyone is here. Just a couple of quick announcements. We do ask that you please hold your questions until the end, as we will be covering a most frequently asked questions section that may answer many of the questions in advance. Also, as much as we would really like to be able to help address individual concerns for a particular building, this is not a great forum for that. And so if you have specific concerns about your individual building, we would be happy to address those concerns offline with your account executive, who really should be part of the discussion. I've tried to respond to as many questions as I could that were received in advance of this webinar in response to the proposals that were distributed. If you have asked a question offline that I have not responded to yet, that's because my focus has really been on disseminating all the proposals to all the clients first, so that they too would have an opportunity to ask questions before the renewal dates. Many of you do know me, so if you do not, just some quick, sort of background about who I am. I joined ORCID 16 years ago with the purpose of constructing and developing and then subsequently maintaining a risk management program. I came from the insurance industry. I used to work as a program manager for a boutique insurance program manager who wrote high-end real estate. ORCID was a client, and we had developed a relationship over many years. I am a licensed insurance broker and a licensed general adjuster. And the ORCID risk management program is now 16 years strong. I consider it to be a very successful program, and I think that we've done a tremendous amount to improve the risk profile of our buildings to the various markets. So tonight, we're going to certainly talk about insurance. We're going to talk about some of the market conditions that have led to some of the renewal conditions that you will see in the various proposals for each of your buildings. So it'll be a fairly robust discussion that centers around, just sort of the individual elements of the insurance portfolios for each of the buildings, and then we'll talk about some of the conditions that exist in the marketplace today and some of the challenges that we're facing. You can go to the next slide. We're going to be looking at the sample proposal first, and then we will go through the frequently asked questions, and then there's two exclusions that are sort of new to the insurance policies this year, one on the property side, one on the liability side, and so we'll talk briefly about those and sort of what they mean. So many of you are with either one of two partner brokers who Gotham Risk Management Group and ORCID New York is doing business with. You're with either York International Agency or Owens Group. I consider both of them to be premier brokers in writing habitational real estate in New York City. And I frankly don't think there's anyone who's better at not only underwriting or helping us getting these things underwritten, but also servicing the accounts. ORCID's entire portfolio, with very few exceptions, is on a common expiration date, which is May 1st, which is coming up, just in another 10 days or so here. Next slide. All right. Make it a little bit bigger for my aging eyes. Here we go. Okay. So I'm using the York proposal just because for me and my eyes, it's a little bit easier for me to see it, the contrast, and it's slightly more simplified than the Owens Group proposal, although both of them are very good in the proposals that we've worked on together. So for those of you who have had either this proposal or the other one, the information is relatively the same. I just find this one's a little easier to look at for purposes of this webinar. So somewhere on your proposal, you will see the location, which would be the street address of the building. On the cover page would be the named insured. We include the square footage of the building, and we also include any sort of commercial square footage and then the number of units. Each building has its own sort of individual portfolio of insurance, and it consists of several lines of coverage. I'm going to be speaking first tonight about the commercial package policy. This is what I would consider to be your primary policy in the sense that it's the policy that covers both your building for physical damage, and it also covers you for third-party liability claims through the general liability section. It's called the commercial package because it packages those two coverages together along with your boiler and machinery coverage. Then we'll move briefly into the crime fidelity bond coverage, which as of a couple of years ago, we combined with the directors and officers liability insurance. We'll talk about the reasons why we made that combination. And then we'll talk about the umbrella, which is a sort of a hot topic this year. Many of the buildings also, almost all the buildings at this point, are also part of our master pollution policy. That's a 3-year policy that was renewed 2 years ago, and it will come up again in 2022. It's not reflected on this proposal, but for those buildings that have it, it's about a $1,700 a year annual premium, and it covers you for pollutant events, such as if you had an oil tank that were leaking, you would be covered both for the cleanup costs on your own property, and if that oil unfortunately seeped into the neighbor's property, you would also be covered for the third-party claim against you by your neighbor. The little section in the bottom here that says the package premium is subject to a 2-year conditional loss ratio retention rate lock agreement, which is a mouthful. What that means is that's making a reference to the rate lock that we've talked so much about and that we've had a great deal of success with since 2015. Most of the buildings have been included in the rate lock agreement. There is a handful that have not, and I'm proud to say that there's 2 that were initially not included that we have continued to fight about and will now be included, and I'll be sending them emails separately about that. Move to the next slide. Now you're really going to challenge my eyes. You can make that just a tiny bit bigger, Chelsea. That'd be great. Okay, great. So starting with the commercial package policy, we'll start first with the property. If you look at the 2 columns to the right, you'll see that there's an expiring column and a renewal column. I've included both insurance companies who are writing what I would consider 99% of our portfolio. So not only are you with either Owens or York, you're likely also either with Greater New York Mutual or Admiral Indemnity, who is now known actually as Berkeley Luxury Group. Same company, just a different trade name. So we'll start with the property and the building limits. The first row you see there is in bold. It says building, and there's some numbers there. Those are what's considered to be the agreed value replacement cost for your building, meaning that the insurance company and you have agreed, or we have agreed, that this is the approximate cost to reconstruct the building if there were a loss that were so substantial that the building were destroyed or substantially destroyed. In addition to that, if you look down after those 3 words included, then you'll see something called building limit with ERC. That's an enhancement that we negotiated many, many years ago. And the purpose of that is that if the loss was so substantial that it exceeded your base building limit, which in this case under the expiring column is $22,218,360, then you would have an additional 25% worth of limits in excess of that for reconstruction costs. The next column over is simply the difference between the expiring values and the renewal values. And the slight adjustment that you see there is something that's known as inflation guard. So, we have an agreement with the insurance companies that if we maintain a certain level of insurance under the base building limit, that they will continue to provide this ERC limit in addition. And so these little fluctuations that you'll see from year to year are just the inflation guard difference between the construction costs year over year. As we go down from there, we have equipment breakdown, which again covers your boiler and machinery. We have your deductible there, which in this case is $5,000. Building ordinance or law, which is within the limit, and then demolition and increased cost of construction. So this is your sort of base building coverage, meaning for physical damage due to a covered cause of loss to your building. Physical damage meaning that it's been caused by an incident or an occurrence as defined under the policy, which resulted in physical damage, which could be traced back to a time and place. These are not maintenance policies in the sense that, you had some wear and tear and the bricks are getting old and they're sort of falling off the building and the sidewalk is getting old and we need to fix that. These are for insured events. So, and then scrolling down, you'll see there's the business income, extra expense component. What it says over there, instead of a dollar limit, you have a time limit. It says actual loss sustained up to 24 months. What that means is that we have provided the equivalent of 2 years worth of revenue for your building, whatever that is, whether it's maintenance, common charges, whether you have commercial revenue or any other revenue that's insurable under the policy. We've estimated a 2-year value of that, and we've given that to the insurance company in exchange for this 24-month ALS. So what that means is that whatever the loss actually is, whatever is incurred over the course of those 24 months is what the limit is, assuming it doesn't substantially exceed the guidance that we've given them for whatever reason. There is a waiting period for that as in terms of a deductible. So it's similar to the time limit. There's a timed deductible, which in this case is 72 hours. The business personal property shows here is $100,000. So if you thought of your building as a box, anything that's not permanently installed and belongs to the corporation or the condominium association is what's covered under this business personal property. So if you have tools, snow blowers, other non-permanently installed items, this is where the coverage would be. So I just try to think of it as a box. If you held the box upside down, whatever falls out, that's your business personal property. The deductible for that is $5,000, and we apply a similar inflation guard increase to that whenever the building value goes up. For those buildings that are not flood zone, which is the vast majority of our buildings, we do have a couple of buildings that are in designated flood hazard areas. In that case, you will not see a $10 million flood limit on your proposal. You will likely see that it's excluded, and we're probably dealing with you separately with an NFIP policy and then excess flood coverage. Something that would be unique to your building. In this case, this building, in this example, is not in a flood zone, and so the insurance company is quite happy to provide $10 million worth of flood coverage, subject to a $10,000 deductible. In the earthquake category here, there's a $25 million limit. Many of you will probably recall that in 2017, we had published something that really sort of drew everyone's attention to the fact that New York City is in a seismic zone and there is a potential for earthquake in New York City. I will say the vast majority of our buildings did take advantage of the fact that we were finally able to convince the insurance companies to allow this higher limit. Prior to this, they had not allowed anything higher than $10 million. But after years of badgering, they finally agreed to allow us to buy up a higher limit. It was pretty cost effective at the time. For those buildings that didn't buy it up, it's still available. It's slightly more expensive, not tremendously more expensive, but slightly more expensive. And so if that's something you have an interest in and that you'd like to reconsider, you should reach out to your account executive or to me. The deductible that goes along with that is $25,000. The rest of these things are really sort of, water damage type claims are pretty standard. So we're back up, at least for these two insurance companies. And these are sort of the things that I think, some of the things that sort of separate these two insurance companies. And just to, backtrack for a quick second, the reason why we're with either Greater New York Mutual or Admiral, in this case, Berkeley Luxury Group, is they really are the two top markets for habitational real estate in New York City. They offer the broadest coverage. They offer the most favorable rates. And particularly in our program, they're quite sensitive to the needs that we have and the sort of unique challenges some of our buildings are facing. And so many other carriers outside of what I would consider, top tier, either have sublimits or even exclusions for things like sewer backup, underground water, or seepage, things like that. So these are coverages that, are often overlooked, but can become really important coverages if you actually have one of these perils strike your building. Loss due to virus or bacteria. So that's something that we should probably just talk about for a quick second. We talk about, mold and things like that. Mold is something that's sort of separate. The mystery mold, which is that, if someone suddenly has mold in their apartment and it really can't be traced back to any other sort of covered cause of loss, technically the insurance companies exclude mold from coverage. Where the mold is as a result or a consequence of, a covered cause of loss, it's always included. And so there's an important distinction there to be made. This is really important. This is one of the things that we harp on the account executives about, is if you have a water damage event, it's sort of important to make a record with the insurance company, because it's possible that sometime down the line that you could discover mold and you wouldn't want to be in a predicament where, there was nothing ever reported. And suddenly there's this mystery mold and there's no, prior water event that could have given rise to it. And so something just to think about. And then terrorism, and we're going to talk a little bit about these two new exclusions that have gone on to the policies, having to do with the pandemic. And in one case on the property policy, there's an exclusion, and then there's also an exclusion under the general liability. And I sort of look at these things as, a knee-jerk reaction of the industry. And they've had similar reactions to mold. Many of you may remember many years ago, mold was like the hot topic. The litigation bar was after it, and there was all kinds of litigation around this whole mold situation. And so eventually the insurance companies were sort of forced into, particularly in New York, providing some coverage for it. Similar circumstance with terrorism, of course, when the events of 9/11 happened, which I can't believe it's going to be 20 years already this year, but it is. The insurance companies were immediately, aiming to start to exclude terrorism coverage, and eventually we were able to work out something, with the federal government for a backstop, and they were able to provide that coverage. And I think, much as these new exclusions were quickly added to the policies, not just these policies, but pretty much across the board throughout the insurance industry, I think there's going to have to be some rolling back of that and some discussion as we all move forward, because the knee-jerk reaction is fine, but at the end of the day, this sort of pandemic has never really happened before, at least not in modern history, and it's something that we're going to have to deal with going forward. And so I think there's going to be more dialogue on that front. All right, so if you just scroll down to the general liability section there. The general liability policy, this is the section of your package policy which really covers third-party liability claims, trip and falls, slip and falls, other covered events that result in a bodily injury claim being brought against the condominium or the co-op. Your basic general liability limit is $1 million per occurrence. What that means is that if one person slips and falls on your lobby floor, that event has $1 million limit attached to it. You have a general aggregate of $2 million. So if three people were to slip and fall on your lobby floors, that's three separate occurrences. And while they each have $1 million potential attached to them, you have an aggregate limit of $2 million. And then you have an umbrella policy which sits over the occurrence limit that's now $175 million, which we'll talk more about. Hired non-owned auto is just kind of a throw-in coverage. We know that most buildings don't have autos, but this is any liability that sort of arises out of your either hiring or liability of use of a non-owned auto. Employee benefits liability, EVL deductible is $1,000. So employee benefits liability is not something that you should have tremendous concern about. For most buildings, your employee benefits are at this point handled by the union. And for those buildings that are not union buildings and don't also have employee benefits, it's probably not really a real exposure there. Water damage legal liability in some cases for buildings that have some very frequent losses. There will sometimes be many claims over a period of time. That's included in the incurrence limit, so those claims are covered there. Same thing for mold liability. We just talked about. This is something that was initially sort of a knee-jerk reaction in the industry that we're going to try and exclude everything, and now it's all included, particularly in New York. Of course, outside of New York, it's still excluded under many policies. Lead liability is another thing that I think sort of separates these two insurance companies from their competition, in that sense that most other companies are going to exclude lead. Then the communicable disease exclusion, which is now included on the policy, which means that because it's an exclusion, you've now reduced your coverage. This is something that we're going to go over in a little bit. This one is where I think there needs to be really more dialogue, because while it's sort of hard to imagine how the damage due to virus or bacteria would result in physical damage to your building, I think the purpose of that under the property component of the policy was really to try to avoid the business interruption exposure, meaning that, if you scroll back up, Chelsea, just for a quick second. So under the property, you have your that 24 months ALS. So the way that sort of works is that if you have a covered cause of loss, let's say you had a fire in an apartment, the apartment now is uninhabitable. Under most governing documents, particularly in the co-ops, the proprietary lease, for example, says that if the apartment becomes wholly or partially uninhabitable as a result of a casualty loss or some other loss, generally covered by insurance policies, that the maintenance shall abate thereto until such time it becomes habitable again. So in essence, if the apartment's uninhabitable for, let's call it a year, then the maintenance for that same time period, we'll call it the period of restoration, would also be covered, because if the co-op is not able to collect the maintenance because the apartment is uninhabitable, then it would be collectible under the insurance policy. So that's sort of I think the exposure, particularly on the commercial side, that the insurance companies are trying to avoid right now with these pandemic exclusions. All right, so back down to the general liability. So this one is a communicable disease exclusion. This is new this year, which is why it says included under the expiring and excluded under the renewal. This one, I think we're going to talk a little bit more about. And as I said, the dialogue with the insurance companies is going to be continuing, because, this is something where we'd at least like to see a sublimit or some sort of a defense obligation for what is ultimately, a bodily injury claim, which is something that falls squarely within the wheelhouse of these policies. But currently that does not provide for any sort of coverage whatsoever. We fully understand how difficult and probably impossible it would be for a claimant to prove that, for instance, if they came into the building and then claimed that they caught COVID from a doorman or, some other, method through the building's facilities. Extremely difficult to prove, considering they may have just come off the subway, gotten out of a taxi, who knows where they were. So we understand all of that. But, the cost of defending such a claim, could be a substantial cost. And so we'd like to at least get some defense costs thrown in here. There's nothing that's going to happen for it this year, but it's certainly going to be top of our radar screen in the following renewal cycles. Okay, we can scroll next page. Next policy worth discussing here is your crime fidelity bond. This is a policy that's generally intended to cover financial losses due to theft, dishonesty. You can see all the various iterations here, forgeries, alterations, things like that. A number of years ago, we combined this policy with the directors and officers liability policy that's written through Travelers. There was a benefit in doing so, and we did it in the same year in which we included the cyber liability and the social engineering fraud coverage under the policy. And it turned out that the discount that we got for combining the policies together actually covered the premium for adding those additional coverages. The limits are relatively standard in the sense that, unless the building has a substantial reserve fund, we will have them insured for the minimum, what we consider that sort of the minimum Fannie Mae guidelines, which is about 4 months worth of revenue. So some of you may have seen emails from folks that are trying to refinance, and you get something from your lender that says, hey, the building's crime policy needs to be increased. That's the calculation that they're doing, because it exists in the Fannie Mae guidelines and the Fannie Freddie guidelines. Several buildings that we have a substantial reserve, and in those cases, because they're long-term reserves and aren't earmarked for anything in the near term, they've insured for those. Cyber liability, there was just an article just recently, which we're going to be distributing some more information about how one of our competitors was hacked, and they're now in the process of going through the notification and process and things like that. This cyber liability coverage is intended to cover such costs and such exposures. Social engineering fraud is something that you've all heard of. You may not have heard of it referred to as social engineering fraud, but in essence, what it is the email that you get from your cousin who's now trapped in a South American country and has no phone or any other way of communicating and need you to send them $5,000 through the wire service so that he can get home. That's considered social engineering fraud. It's when a board member or an employee is intentionally misled into sending money or diverting a payment based on fraudulent information. People sort of shrug their shoulders and say, that's no one ever falls for that. But the reality is that people do fall for it. We've had a number of buildings that have come into our portfolio with these sorts of losses that were pending. And so just as a good matter, it's a matter of good practice is, whoever on the board is responsible for the reserve account, assuming that it's not the managing agent or maybe it's in combination with the managing agent, never operate solely by email. Always have, good verbal communication to verify these sorts of wire transfers and things like that when those requests come through. The hackers, I will say, have become extremely talented in this regard, and, they can really mislead people quite easily. Okay, the directors and officers liability. This is probably, if you're a board member and you're on this call, the most important policy to you personally. The limit of liability here is $1,500,000. We're carrying $1,500,000 because it was under an agreement with the umbrella carrier to carry slightly more than $1 million, and so this is what we agreed on. This policy does not cover bodily injury or property damage. In fact, it's intended to exclude bodily injury and property damage. What it's intended to cover is wrongful acts and allegations of wrongful acts against the fiduciaries of the corporation and or the condominium. For instance, if somebody were to bring a claim because a sale was rejected and they wanted to bring a claim to suggest that it was rejected inappropriately or for inappropriate reasons, this is the sort of place where it would be covered. There's a whole host of other types of claims, but basically, if you think of a wrongful act that's not related to bodily injury or property damage, this is where the coverage would lie. That would include employment practices liability. We've negotiated unlimited defense costs, meaning the defense costs are now outside the limits rather than eroding your limits. So the $1.5 million is strictly an indemnity limit available for settlements. One of the reasons why we think the traveler's policy is really superb is it does include a wage and hour defense costs. Most policies these days are simply excluding that. What wage and hour is an exposure that's become sort of more of another hot topic amongst the plaintiffs bar, in the sense that an employee can make a claim that they weren't appropriately paid for the hours that they worked, and the burden really falls on the employer to make sure that they have the appropriate records to show that the employee was appropriately paid. Of course, if it's determined that the employee was not appropriately paid, those exposures are not covered by insurance, but at least you have the defense costs covered. So it gives you a basis to at least fight from, because many times these claims will come up, after a termination has happened or something like that, where there's some sort of bad blood, and it's, excuse me. Okay. And then the managing agent's rider is simply the rider through which the managing agent is also covered under this policy, and there's a similar rider under the crime policy. All right, so now we get to the umbrella policy. Of course, it does have a master umbrella policy that each of our buildings has access to. Is written through an RPG, which stands for a risk purchasing group. This is not just for ORCID. There is a large conglomerate of other managing agents who are also involved in this, and this is through the Vanderbilt program. I will say that the umbrella programs and the umbrella industry has been sort of the hardest hit throughout the rest of the industry in terms of what we're seeing in the market today. And the primary reason for that is quite simple. The labor law claims have just gotten completely out of control. And the runaway verdicts and the sort of lack of ability to transfer these risks to the responsible parties has really put a tremendous strain on the insurance industry, to the point where, with almost the exclusive exception of this program, every other program has almost collapsed at this point, to the extent that our $200 million limits have gone down to under 50 million in some cases. Some smaller buildings, I'm told by some of the brokers, have opted to not even carry an umbrella limit because they just can't afford it. The rates have gone up tremendously. From what we understand from some of the benchmarking we've heard about, We're seeing hundreds of percent increases on the premium for, just a small percentage of the limit that was previously in place. So while we understand that a 30% increase this year on the heels of a 35% increase last year sounds sort of treacherous and unreasonable, I'll tell you that it's the best result that exists in the market today. And, we're sort of hopeful that our program is going to last beyond next year's renewal. They've taken a number of steps to make sure that all of the members are really focused on risk transfer, and that's something that we'll talk a little bit more about. But certainly within the walls of our office, it's been a topic of hot topic discussion. I just gave a seminar the other day to all of our account executives about the importance of it and some things to focus on. But right now, it's really a moving target, and so we're very focused on that. We are happy to say that our $200 million limit has reduced only down to $175 million. I will tell you that I am extremely comfortable with that limit, and I'll tell you why. We actually had a $100 million limit for many years, and before that, a $50 million limit. And to the extent that the umbrella markets are struggling, I'm sure they're not going to want to hear this if they heard me say it, but I will say that it is a self-inflicted wound. It's not entirely self-inflicted because of the labor laws, but it's self-inflicted in the sense that rather than focusing on the sort of near-term exposures and the lower layers, for many, many years, they really pushed these higher limits. And, we have a $200 million limit, or we had, in some cases, some of the programs were offering $300 million limits, and they were really pushing them hard. And the only way we ended up with a $200 million limit was that we refused it for many, many years. And they finally came to us and said, look, just take the $200 million. We won't charge you for it. And I said, fine, if you're going to give it to me, we'll take it, but we're not paying for it. So I think we'd be quite happy at $100 million. We did look at reducing the 175 to 100 this year, but the cost of the discount to do so was just really not worth it. So there was not enough of a value in doing that, and so we kept it at 175 million. Not to say that next year there may not be another change. There may be, but I think we still have some room here. This is a follow form policy, so what that means is that if the loss is covered under the underlying policy, in this case, the underlying policy is your general liability policy, which we talked about at the top end of this, and your directors and officers policy, which has the $1.5 million limit. Once those limits are exhausted, then you're looking at now $175 million limit. There is no unique exclusions under this policy. So follow form means that if it's covered on the underlying, it's covered here. Okay, so this last section just sort of gives you a sense of who the players are. Let's go back up one slide. Who the players are and who makes up the layers of our insurance policy, in this case, the umbrella. So you can see the Fireman's Fund in there for the first two layers, Liberty and Navigators. Liberty comes back, and then QBE. So, and that's how all these programs work. They're all layered up through various insurance companies. I'll tell you that the real driver for the premium is in the lower limits. And so this is the reason why the limits are coming down and the price is going up, because it's the lower limits that are really increasing their premiums, and as the higher levels are dropping out to mitigate. And the last little footnote here just says, throughout this proposal, higher limits are available and will be quoted at your request. All that means is that in some cases, folks have asked about whether the building values are appropriate, whether they can buy higher limits for the earthquake or for various other things. And so that's why that's down here. Okay, next slide. Okay, this just really gives you each of the insurance companies on the individual proposals have a letter grade assigned to them in terms of their financial strength and their AM Best ratings. That's what these are. This is just a table showing you that what each of those symbols means further into or earlier up into the proposals. Now, just to sort of recap a little bit, our rate lock agreement is something that is, I don't want to say unique in the industry, but it's fairly unique in the sense that I think, we were sort of at the genesis of it. We started this in 2015, and we started to look at it in terms of, whether we were getting really the value of our program through the marketing process. And it was really determined that we weren't getting the value of our program, or at least capturing the value of our program in the marketing process. particularly now when we're in what's considered to be a hard market, property rates are up substantially, liability rates are up substantially as a result of all these labor law claims. Folks have asked, why are the property markets so tough right now? And I'll say that the answer is really, sort of twofold in the sense that, we've had a couple of really strong catastrophic loss years with all the named storms and the hurricanes and, the wildfires out in California. These are catastrophic losses that really strain the insurance industry. And it's not that these insurance companies that are writing our insurance are paying those losses necessarily, but, they're buying insurance from the reinsurance markets, and the reinsurance markets are global markets. And certainly they are in a position to be impacted by all of these various catastrophic losses. And so sort of a trickle-down effect in the sense that the reinsurance markets are strained as they renew their treaties with the underlying markets. Insurance companies buy insurance too. They're not holding on to all the limits that are represented in these proposals. They also have insurance, and that's how it spreads through the industry. So the answer to why rates are up is really that's the answer, is that the markets have been hardening the last several years. Interest rates are low. Insurance companies derive income from their investments as well, and so the interest rates being as low as they are, their investment income has probably been down substantially. And you combine that with some of the losses, and it gives you some insight as to how the markets have hardened the way they have. I feel fortunate that we've been in a position to lock our premiums, particularly since 2015, because I will say, this has been sort of an escalating hard market since maybe 2017 is really when it kind of started, and then, sort of is escalating from there. And so, we've been fortunate in the sense that, where we're seeing, outside buildings that are coming into our portfolio that are getting conditional renewal notices of 20 and 25%. Here we are sitting on a 6% rate lock, for 2 years, so 6% this year, 6% for the second year. We feel that sort of budget certainty offers a tremendous amount of value to our clients. And so, we'll talk a little bit more about, the marketing process and, why we've elected to do this as opposed to some other things. Okay. We'll move to the FAQ. I've received lots of questions over the years, and we've sort of picked out the dozen or so questions that seem to come up most frequently. So we're hoping that, if you have a question, maybe this might answer it for you, but if not, we're happy to try and answer your individual question. And so this just comes up, pretty frequently. Should we be shopping around to see if there are better deals out there? As I sort of alluded to, we did that for many years. I joined Orsa in 2005, and certainly for the first 10 years, we played this, play one insurance company against the other game. And frankly, it was an exercise with very diminishing returns, because it's not as if you're hiring a painting contractor and you can go out to 100 painting contractors and ask for a proposal. There's really only a couple of markets that are willing to write habitation or real estate in New York, particularly if you have a pre-war building. So, it's really a very limited marketplace, and to, sort of play this game year in and year out, it really just becomes, fruitless. And so as opposed to, rather than do that and really sort of tax the underwriting resources for the various insurance companies, we decided that, we have a very strong portfolio, we have a very strong risk management program, and we felt that the value of that really wasn't being capitalized, because even in those years where we did market the accounts to the insurance companies who were willing to bid on it, and there's really 2 or 3 out there. It's not like there's 10 or 12. There's literally 2 or 3. Almost no buildings moved, and very few cases that anyone really moved. And it became obvious to the insurance companies that they were just being used, to reduce pricing. So rather than do that, we decided that we'd start to negotiate pricing based on what our understanding of the market was, and then try and do better. Obviously, in exchange for that, the insurance companies got some stability, and we got some stability. So I think it made sense all the way around. Go ahead. Next slide. How many insurers and which insurers do you approach and ask for proposals this year? Again, it's not as if you can go out to 100 painters. There's really only a couple of markets who are willing to do this stuff and who do it well. There may be other ancillary or secondary markets out there that are willing to quote this stuff if they have the capacity, but I can tell you, it's not an apples to apples comparison. So it's really sort of a pointless exercise to go out and get a policy that doesn't provide anywhere near the amount of coverage that a more premier policy would provide, and then use that to try and negotiate pricing. It's just not achievable. Next question. Would premiums be lower if we got higher deductibles? Very good question, and one that I think sort of stems from folks' experience with their own personal lines policies, where taking a higher deductible has a substantial impact on your premium. With these commercial policies, taking higher deductibles, unless you take a really high deductible, which most of these companies wouldn't even offer, but even if you went up to, say, a $50,000 deductible instead of your $5,000 deductible, the difference in that, maybe a few $1,000s, but if you have one claim, that means that you're going to have many, many years of no claims to make up the difference in the premium savings after just paying that deductible one time. God forbid, if you have two claims, you can double that amount of time. So, where it makes sense, and where some buildings have had some real problems with claims and, tremendous amount of frequency, the deductibles have been forced up by the insurance companies in exchange for some premium relief. And I think there it makes sense. But for buildings that are, falling within the average claims experience, it really doesn't make a tremendous amount of sense to increase the deductibles. A few of the buildings this year who've really stuck to the lowest deductible that was possible have now fallen into below the minimum underwriting requirements. And so, where anyone who had a $3,000 deductible under their property policy, that's now moved up to $5,000, which is the new minimum. Next slide. Why are we receiving our proposal in the month before the insurance expires? Also a good question. Unfortunately, insurance proposals are really only good for 30 days, or insurance quotes rather. So, within that 30 days, a lot of things have to happen, which means that the insurance company has to issue the quote to the broker, in this case, York or Owens. They have to vet the quote, put it into a proposal format, and it has to be sent to me for review. And assuming there's no other questions or concerns, I'll have to take those proposals and get them out to the clients. But generally speaking, the buildings are not able to get them months in advance because the proposals simply aren't valid for anything beyond 30 days. Okay, our umbrella coverage limit has been lowered from 200 million down to 175 million. Why is that? I think we've covered that question. It's really just a strain on the market right now. But I think we're more than comfortable at 175 million. Is $175 million really needed? And can they reduce the premium if we reduce the limit? I think I touched on that briefly. I don't really think that anyone on this call or any of the buildings that we currently are managing necessarily need a $175 million limit. However, we have the $175 million limit, and we didn't really pay for the limit to begin with, for the full limit. And so I think, the premium reduction to reduce it is really de minimis at this point. And so we decided to stay at 175. We don't have the ability to insure one building for a lower limit. The program is at 175. So every building would have to go down to a different limit. It's not as though we have the ability to pick and choose. Okay. In prior years, you sent us a spreadsheet showing competing bids. This year, only a single bid from our prior insurer with rates and terms compared with the prior year. Why the difference? This kind of goes back to the discussion on marketing again, which was really a diminishing return that was using up the underwriter's resources and really did not capitalize on the value of our program, which people sort of look at this like we're buying waterproofing contracts or widgets or something else where we can go out to various different companies and provide the same thing. And ask for proposals. And it's really just not that simple. There's such a limited appetite for this in New York. It's such a risky endeavor these days, particularly with the labor laws being what they are, that, we're trying to capitalize on the value of the markets that are available to us. And we feel that these negotiated rate locks and, capitalizing on the strength of our risk management program is really the way to go. And, the other thing too is that, most people don't think about it in this way, but most people aren't shopping out their personal lines insurance every single year. You're dealing with the Chubb, or you're dealing with AIG or State Farm or Allstate or whoever it is. But for the most part, these are luxury policies, kind of like a Chubb policy would be or an AIG policy would be. They have broad coverage. The servicing is really second to none in the industry. And so it's not as if there's, a ton of companies out there who are really looking to do this. Okay. So co-op at a disadvantage in the insurance market relative to other apartment co-ops, and if so, what is the reason? So the only time that I'll say that, buildings would be, at a disadvantage is if you really have a, negative claims experience. It's sort of hard to be out in the marketplace and shopping your insurance. Even if you have good claims experience, sometimes it's not easy to go out and shop your insurance. But, once you start to have some claims on the books, the look back period is 5 years. So even people, or rather buildings that have claims in 2016, it's not necessarily easy to go out and shop that. I will say, I think that being in the ORSID program is a distinct advantage. And I'll say the reason for that is that, as much as the insurance companies will charge premium and raise deductibles for buildings that are really laden with claims, what they won't do is they won't non-renew the policy. We have an agreement with them that we don't want to be in a position where they're cherry picking the portfolio. Today's cherries are, tomorrow's blossoms that have fallen on the floor. Any building, and I have to say every building, will eventually have a claim. And to start to allow the insurance company to start cherry picking the portfolio is really counterproductive and sort of counterintuitive to what we're trying to achieve here. And so, we've had a number of buildings that have had, years where they've had, frequency of claims, severity of claims, or both. And the insurance companies have really stood by those buildings and really stood by the program to the point where, if you're willing to allow them to stand by you as opposed to going out into the marketplace and trying to replace them, which is going to be difficult to do, then you will, eventually get back to, square one. In those buildings, I'm happy to say, where they've seen higher premiums and higher deductibles, we've been successful in negotiating them back down as the loss runs improve. Okay. Note that we lost coverage for COVID and other diseases. This is universal for the market, then so be it. But this is why our carrier, or only for our carrier, it would be good to understand why, as COVID doesn't seem to be going away. And as I said earlier in the webinar, it really was sort of a reaction to, something that was sort of flaunted on not only insurance companies, but on all of us. And this is sort of typical for the industry. It's certainly not just these insurance carriers who've done this. It's virtually every insurance company that I'm aware of has in some way, shape, or form sort of closed the loophole. On the property side, as I said, I'm not sure, it'd be hard to define a coverage or an incident or an occurrence that would result in physical damage and coverage under the policy. For those buildings that had commercial losses, meaning that, their restaurant went out of business and they lost the income and it was all due to COVID, that business income component of coverage only really kicks in where there's physical damage. And of course, there was no physical damage to the building. And so for those buildings, they had no coverage there. And so on the property side, it was really just a matter of, sort of closing the possibility out for that coverage. On the liability side, I think, as I said, it's a little more problematic in the sense that I could foresee somebody making a claim against a building saying that I caught COVID or, some other, similar communicable disease or something, because I went into this building. And that's something that I think is going to be part of our discussion going forward. Why is our building not part of the rate lock? The answer is usually pretty simple. It usually has to do with buildings that have really had substantial claims, either in severe claims or frequency of claims. I make a distinction between the two and don't just say claims, because sometimes, even a building that has a severe claim, they had a fire, they had a flood, in a look back period of 5 years, they've had really one substantial claim. That was not anything, having to do with, bad behavior on behalf of the insured. And so those buildings, I think, the insurance companies can't lock themselves into a rate for the coming years because they don't sort of know, what's going to happen claims-wise. For those buildings that have, reasonable claims experience, they were part of the rate lock. And just because you had one claim didn't mean that you were excluded. It was really buildings that had, substantial or frequent claims. We had a couple of buildings that were initially excluded from the rate lock because the rates were just too low, and we've kept rates low for a very long time. In some cases where they've now fallen below the minimum underwriting guidelines, and so in those cases, we've had to sort of make some additional arrangements for negotiating something better. But I'm happy to say that those two buildings have now been included. Is there any coverage that we should consider that is not currently included in our policy? I think that the policies as they exist are pretty robust. We did make a recommendation in 2017 about increasing the earthquake coverage. I felt that was a peril that was sort of undervaluated and something that we need to consider, and most of the buildings did. We're constantly looking at, other areas of the policies where there could be some emerging exposures. We added social engineering, we added cyber coverage. So we're sort of always trying to look at, some emerging exposures and make sure that we have the appropriate coverage for that. Are our limits sufficient, and would you recommend any changes in our limits? We have recommended changes along the way. When we first got this program going in 2005, one of the first things that we started to look at were the building values, and where you see most of the buildings are now insured somewhere between $300 to $400 a square foot. We know that the actual reconstruction costs for total destruction would probably be somewhere in the neighborhood of $700 to $900 a square foot. But like every other building, we're not insuring for the maximum possible loss necessarily. We're insuring for the maximum probable loss, and so I think we're in a good place there, and we are making recommendations as necessary. This is not a great time to be buying or increasing your limits, just given where rates are. One of the things that we're going to be looking at in the coming years is the business interruption limit. The 24 months ALS is something that we feel will probably cover most general claims, but if you ever really had a catastrophic loss, we feel that limit may be, subject to challenge. And so that's something we'll be looking at in the future and communicating with all of you about. And then the next two slides, this one and the next one, are really just, the examples of the exclusions that have been added to the policy. This is the property exclusion, and it's the New York exclusion of loss due to virus or bacteria. Both of these exclusions were ISO forms that were sort of easily added to every insurance policy that wanted them because they're already standardized forms, and it's not as if they have to go and get special filing for this. And so this is what they ended up with. Again, this is what the exclusion says, and it talks about, loss or damage due to due to virus or bacteria. The next one is the communicable disease exclusion on the liability side. And this is something that I think, as I said earlier, that we're going to be challenging and trying to get at least something back on the defense obligation as time goes on. But this is what it is for this renewal cycle. A couple of other topics that we'd like to just sort of introduce that you may have heard about already. We just sort of briefly touched on the importance of risk transfer. This has become really a hot topic in the sense that we have to be extra vigilant in making sure that in our waterproofing contractors and really any of the trades contractors, who we're bringing into the building, we need to make sure that we have the appropriate risk transfer documents in place, which means that we have the certificates of insurance, that they're accurate, that they're up to date, that the contracts for time and material vendors are being captured in indemnity agreements and things like that, because almost all of these policies now require a contract in order to get the additional insured status under these policies, which means that if you have a certificate that says and so-and-so is included as additional insured, and you continue to read, it'll say either as required by written contract or as per policy terms and conditions, or half a dozen other ways they can word it. That certificate in and of itself doesn't do anything for us without the indemnity agreement that goes along with it, that both we and the contractor have signed, that says they agree to name us as an additional insurer. They agree that their insurance will apply on a primary non-contributory basis. They agree that they're waiving subrogation and some of the other things that we're looking for. So more to come on that. You probably are going to hear some of this from your account executives, because it's something that we've really pulled the ropes in on more recently, and it's really being forced by the umbrella markets who are putting out some pretty strict requirements in terms of requiring certain insurance limits and things like that. So it's a discussion that you're going to hear more about. And then the next slide, we've talked about this. We've held some seminars for some of the buildings, but, coming soon, the importance of homeowners insurance policies for shareholders and unit owners. This is something that, we're really asking buildings to focus on because, first of all, we don't want folks to get hurt after the fact when there's a loss. And then you discover that your insurance policy doesn't cover you for the things that you thought you had coverage for. We've had some buildings that really have had some substantial, water damage claims and things like that. And, some of the folks have learned that their broker, whoever they use for their insurance agent, didn't do the right thing for them, and they didn't increase the appropriate limits where they needed to. And so they've been sort of out of pocket on some of that stuff. And so, we've undertaken sort of an effort to, try and educate people and get people a little bit more involved in understanding how the co-op and condo policy works in conjunction with their own homeowners policy. So that's an important topic that we think you need to hear more about in the near future. And I think that concludes the presentation. We've gone a little over our time limit, and hopefully there's still some folks left, but we're certainly able to take some questions now.
Yeah, Eric, just looking at the chat, and just so people know, you can either write your question in the chat or in the Q&A. The first question that came in, Eric, says, my building has made no claims in the past year. Are our premiums increasing at the same rate as buildings which made claims, for example, losses due to COVID?
So I would say the answer to that question is no. For those buildings that are being excluded from the rate lock, they're buildings that have really driven the loss ratios. Every building, in the last year has had a different experience. Some have had some claims, some have not had some claims. But I will say that it's probably, the market right now is such that even buildings that have had no claims are seeing, 20% plus increases. And so I think it's 6%. I think that's well below market, and so I don't think it means that any building is paying for the claims of any other building.
I don't see any questions in the Q&A. I see that Nancy Ruskin raised her hand. Nancy, if you'd like to write your question in the chat or the Q&A, we'll be happy to answer it.
If for some reason you're not able to do that, certainly we can take your question offline. We'd be happy to discuss it with you.
Yeah, Eric, another question just came in. It's a similar question. Building that's had minimal claims, if any, yet insurance increase is above 6%. What would be that explanation?
Well, it's hard to say whether we're talking about the package. It's sort of a general question. Each policy is subject to its own rating. But for the most part, those buildings that were included in the rate lock received a 6% package increase. In many of the proposals that I sent out, I didn't necessarily identify that because it was already discussed in the letter. What I identified was the overall increase, which was the entire portfolio increase, which generally speaking included a 6% increase on the package. So maybe it could just be a distinction between the overall increase and the package increase.
Eric, I see one more question that came in. So, and it's with respect to the cyber liability coverage, what types of events would it cover for buildings or boards? And as to the boards, why not cover by D&O?
It's not a D&O coverage. It's something that's clearly covered under the crime policy now as per the cyber liability. What it really covers is breaches, data breaches. And so, if the building had a data breach, meaning if somebody hacked into your building link system or if somebody hacked into any other system which, potentially housed personal information, there's an automatic trigger and an obligation for the building, the corporation who was hacked to do certain things in terms of notifying those folks who may have been exposed, credit monitoring, those sorts of things. It could be something as simple as, a board member's email being hacked, where you had, confidential information about sales packages or something like that. It could be something as simple as that. But It's usually not as something as simple as that, but I'm just using that as an example. Orsted carries its own cyber liability policy. So if Orsted were hacked, we would have our own coverage. And I think we're about to distribute something that talks a little bit more about that, given the recent breach for one of our competitors.
And Eric, I think that that does it for our questions. So thank you very much.
Well, thank all of you, and I appreciate everyone who attended and gave their time tonight. As always, I'm certainly happy to try and address any questions or concerns offline. Just simply send an email to your account executive. It's certainly important that they be part of this dialogue and the discussion.
Thanks, Eric. Thanks, everybody. Have a good night.
Thanks, everybody. Okay.